Looking to invest in the stock market but don't know where to start? Don't let uncertainty hold you back from investing in the stock market. Trust our proven process and start making informed investment decisions today. Investing in stocks can be intimidating, but our three-step process simplifies the process and helps you make informed investment decisions. With our approach, you can confidently invest in the stock market and grow your portfolio over time.
We are all familiar with stories of stocks like Titan, Infosys, and Asian Paints turning thousands into crores. However, for every Asian Paints, there are hundreds of Dutch stocks which lead to disappointment and lost investments.
Our three-step process for selecting stocks can help you make informed investment decisions and maximize your chances of picking the next Titan or Asian Paints.
This process takes into account a company's valuation while keeping in mind its growth potential as well as the quality of its business and management.
In our previous video on shortlisting stocks, we have already shown you how to weed out bad quality companies or those with shady management, ensuring that you only invest in high quality companies with strong growth potential. After we have completed the first step of our process, we will be left with a pool of companies that meet our initial criteria. The second step of our process is to sort these companies into 5 quality buckets, which will help us better evaluate and compare them. Let's start with step 2, sorting companies into 5 quality buckets. To sort the companies into these quality buckets, we need to use a combination of quantitative and qualitative analysis. Quantitative analysis involves looking at key financial metrics such as revenue growth, profit margins, and return on equity. Qualitative analysis involves looking at factors such as the quality of management, the competitive landscape, and industry trends. The viewer will wonder why we need to evaluate companies in each category rather than simply choosing the best quality companies. There are two reasons for this. The first is simple: valuation comfort. High quality companies are seldom available cheap, and more than often, investors end up paying a very high price for them. By sorting these companies into buckets and then evaluating each bucket appropriately, investors ensure that they pay a fair price for each company based on the category into which it falls. The second reason has to do with the fact that the price paid for high quality growth companies discounts earnings from many years in the future. Since these earnings are being discounted to the present, any increase in the interest rates tends to affect these companies' valuations disproportionately. Hence, by selecting companies from different categories, we can reduce our risk of being affected due to a rise in the interest rates. The 5 quality buckets are as follows. 1. Long-term compounders. These are companies with strong financials, high return on equity, and a long runway of growth. They are typically well managed, have a competitive advantage, and are leaders in their respective industries. An example of such a company is HDFC Bank. 2. Blue chip stalwarts. These are companies that have good financials, high return on equity, and a decent track record of growth. They are typically well managed, have a competitive advantage, but may not have long runways of growth, as their markets may have already been reasonably penetrated. An example of such a company is Hindustan Unilever. 3. Growth oriented companies. These are typically smaller sized companies that have reasonable financials, a reasonable return on equity, and a great track record of growth. The management of these companies may not be of the highest caliber, but they have a competitive advantage and have long runways of growth. An example of such a company is Indian Energy Exchange. 4. Cyclical companies. These are companies whose business is cyclical but who dominate their respective industries. They have reasonable financials, a reasonable return on equity, and an inconsistent track record of growth, as their industry tends to move up and down with the business cycle. The management of these companies may not be of the highest caliber, but they have a competitive advantage and have average prospects for growth. An example of such a company is Coal India. Finally, the fifth bucket consists of lower quality companies. These are companies that have weaker financials, average return on equity, and a spotty track record of growth. They may also not be well managed, have limited competitive advantages, or be in an unattractive industry. An example of such a company is Rain Industries. Once step 2 is concluded, investors will typically have 50 to 100 companies in each bucket. In step 3, we further sort these companies based on their valuation, management quality, and business quality to determine the best investment opportunities. By comparing companies on these three factors, we identify undervalued stocks with strong management teams and competitive advantages in their respective industries. This concludes our video on step 2 of shortlisting stocks.